Okay, now we're going to get to talk about assets and liabilities. So we covered it briefly whenever we did your financial snapshot and gave you examples of assets bringing money into your life and liabilities taking money out of your life. But now we're going to dig deeper into what are the different types of assets and what can you do about it? And then what are the different liabilities and how can you use them to your advantage? So first up, assets. What the heck are assets? Well, there's a lots of different types, and you want to make sure that you're familiar at least with all of the big ones so that you can understand whenever people are talking to you, when you're speaking to a banker. I mean, if you're going to try to apply for financing at any point, the lending officer is most likely going to want a list of all of your assets. Well, if you don't know what your assets are, then you're not going to be able to give them that information. So we start by the easy ones: cash, stocks, bonds, etc. These are all the standard, typical ones that you see in pamphlets and in movies and the ones that your mom and dad told you about and so on. Cash is pretty simple. We just did an entire module on money. So that's what that is, right? So the amount of cash you have, it can be important. Liquid cash is something that you can use to make yourself a much more attractive target for lending. So, and oftentimes the underwriters at a bank will require that you have a certain amount of cash reserves or liquid cash. They'll use those kinds of terms. And by liquid, they mean it's not invested in like a property or some type of investment that you can't get access to it. Liquid is, for example, in like a checking account where you can go to the ATM and pull money out. That's whenever they use the term liquid, they mean that cash that you can get access to quickly. So cash reserves are important, not just for being able to pay your bills, but also to, in case something happens, right? You've heard having an emergency fund. That's typically in the form of cash reserves, not dollars sitting under a mattress, but typically it's money in the bank. And if you use USAA and maybe federal or, whatever, you're going to have an account and it's going to have a certain amount of cash in it. So that's what we mean by that. Really nothing else to cover on there. Stocks. This isn't a stock course. You can learn about stocks in a bunch of different arenas, but essentially a stock is just a share of a particular company. So like Apple stock, for instance, you can buy Apple stock for a certain amount of money and you'll get a certain number of shares of stock that is considered equity in that company. So if the value of that company goes up, the value of your stocks go up. Right? I'm oversimplifying this a lot, but effectively, when people talk about stocks, that's what they mean. It's typically an equity share in a publicly traded company. Bonds are a much lower yield, much safer alternative that's guaranteed by the government. So in bonds, you're normally going to get a much lower return, but the risk profile is much, much lower because the government itself would have to default on those bonds in order for you to not get your money. And that's a very unlikely event. And if it does happen, then you have far greater problems at hand than just getting the value of your bonds back. There you go. So there's your standard ones: cash, stocks, bonds. Mutual funds, various things like that, all of those fall within the same category. And in my opinion, you should have a rudimentary understanding of those things. But this course specifically and the Robert Kiyosaki path to financial freedom and the way that we've been able to create a lot of wealth and a lot of financial freedom within White Feather and Cove is not through traditional cash, stocks, bonds, and so on. There are much greater opportunities to lower your risk and rapidly increase your return by learning about these different types of assets that we're going to talk about. Number two, retirement accounts. If you're anything like me, the first time I heard about a retirement account, it was the most boring conversation I had ever had. The guy came up to me and he was this guy in his 50s or 60s in this suit. And he said, "Hey, you need to put your money into First Command and we'll let you grow your money over time. You should create an IRA." What's an IRA? Well, it's an individual retirement account. Okay. I'm at the time I was like 21, right? And so you're talking to me about retiring and I haven't even started my career yet. Like, what? And so I remember listening to him and kind of yawning and being like, whatever. And he said, yeah, and this is the way he pitched it to me. He said, yeah, you start a Roth IRA, you put money into it every month, every month, every month. And when you're 59 and a half, you're going to have a bunch of money. And I remember at the time, like the war in Afghanistan had just kicked off. I was about 6 months from being commissioned as a second lieutenant in the Marine Corps. And then I knew I was going to go to Afghanistan. So I remember thinking to myself, 59 and a half, that is like almost 40 years away. I may be dead in a year. There's no way I'm doing this thing where you're essentially saying that I'm losing my money, right? It's going away into this account. I can't touch it until I'm 60. No way. Like, of course I'm not going to do that. So that's the way it was presented to me. And unfortunately, the way that TSPs and 401ks and 403bs and so on, they're all presented as this, hey, you should just do this. Just put your money in here and don't worry about it. And that's what most people do. Most people who actually have these types of retirement accounts, they just put money in it. It's with their employer. They have no idea what's happening with it. They get this prospectus at the end of the year, this pro forma that talks about how it's performed. And if it goes down, they're like, well, that sucks. It went down, but there's nothing I can do about it. If it goes up, they're like, yay, that's great. It went up. I don't know about how much. I don't know how many fees were taken out. I don't know any of this stuff. I don't know the tax implications, but I know it's smart to put money into a 401k. And so you can say that at a party. Oh, I got a 401k and it sounds great. My point in saying all this is not to belittle these retirement accounts. It's to help you understand that they serve a valuable purpose. You just need to understand how they function. A TSP, thrift savings plan, that is typically what is provided for a military person. Most TSPs don't match, meaning the money that you put in is not going to be matched by your employer. Most TSPs are also fairly limited in the amount of things that they can be invested in. And TSPs in general don't allow you to self-direct, which means you can't put your TSP in real estate. So understand what it is and the value of it. And if at some point in the future, these different specifications for the TSP change and they start matching, or they start allowing you to borrow more from it, or they start allowing you to self-direct it, then okay, great, adjust at that. But in general, it is what it says it is, a savings plan. So that's not a bad thing. The question you have to ask yourself is my money best used in a savings plan, or is it best used elsewhere? And you can only answer that for yourself. But understand, read through and understand how a TSP works. You can go to the Cove website. You can ask in the supplemental materials and with the support teams, you can learn everything you need to know about the TSP. And I would recommend that you do so you can make an informed decision. 401ks and 403bs are what retirement accounts are offered to civilians in the outside world, typically in the corporate world. They'll offer these. Now, 401ks and 403bs oftentimes will match. And so, do you want to take advantage of that match and get that 100% ROI? Do you want to max out your 401k and minimize the amount of taxes that you pay right now because it's, a pre-tax contribution? I don't know. I'm introducing you to it right here because I want you to go take the supplemental materials, work with the support team, and learn about a 401k. If you're outside of the military and you're working in a corporate world and they offer a 401k or 403b, I want you to understand what it is that they're offering. What if they're offering a really high match? Okay, then heck yeah, pour money into it, get that matching money, and let it do what it does. What if they're not offering any match? What if they offer very limited terms? Well, then maybe your money's better outside of that 401k. Does that make sense? So I'm not saying that these things are good or bad. It's like anything else. They're just tools, and you have to understand how they function. A Roth versus a traditional IRA. An IRA is an individual retirement account. It is not linked to any particular employer. It's linked to you. So when you create an IRA, you have to ask yourself, do I create a traditional or do I create a Roth? And all I can tell you is how I approach it. How I approach it is with a traditional IRA, that's pre-tax money, meaning every dollar that you put into that IRA lowers off of your current taxable income. Well, that's pretty powerful because with the time value of money that we understand from the previous videos, I now have more money in my hand right now because I was able to take that amount that I contributed to my traditional IRA off of my taxable income and thus pay less taxes right now, have more money in my pocket right now. With the time value of money, does that mean that that was a smart decision and I can reinvest that money and make it grow faster? Yeah, maybe. Conversely, with a Roth, you do not get the tax benefit right now. You get the tax benefit when you take the money out later. So when I look at that, I have to ask myself, do I plan on being wealthier when I'm 59 and a half than I am right now? For you, you may be like, you know what? I'm in a very high tax bracket right now. I'm making lots of money right now. I expect when I retire to stop working and live off my passive income. So I will be in a much lower tax bracket then. So I need to take the tax advantage now. So a traditional is for me, and that's a great decision. Or you might say, well, I'm in a decent job right now. Maybe I'm in the military. And if I'm in the military, I'm not really getting taxed that much because your BAH is not taxed. And there's a lot of things that you get that are not taxed as well, especially when you deploy and do things like that. So maybe I'm not getting taxed that much right now, but I'm also making 50, 60, 70 grand a year or less. And so I plan on building financial freedom. I plan on being a multimillionaire by the time that I'm 60. And I plan on having a huge amount more income. Well, if that's the case, then a Roth is what you need because you put money into a Roth, you don't get any tax breaks. But let's just say you grow this. In Whitefeather, we have something called $1 million Roth, which is essentially a plan that you embark upon where you maximize the amount that you put into your Roth IRA, and then you bounce that from real estate to private lending opportunities to hard money lending opportunities to startups and all this different stuff. And well before you hit 59 and a half, you've got $1 million in there and it's in cash flowing assets. So by the time you get ready to start drawing off of it, you have 7 figures plus inside your IRA and you're able to draw this money and none of it, you paid taxes on none of it. And that's the beautiful part is you can grow millions of dollars tax-free inside a Roth IRA. So these things don't have to be boring. They can be sexy because think about this. And this is where I screwed up when I was 21. I thought to myself, oh, if I can't touch that money until I'm 60, then I'm just wasting it. But the way I look at it now, and even like right now, while I'm recording this, I'm 41. I still have 20 years basically before I can touch my Roth money. But I'm building up $1 million plus in my Roth IRA. And what does that allow me to do? It gives me essentially a safety net. If I screw everything else up, all I got to do is hold on till I hit 59. And then I'm able to get access to millions of dollars, which means that I'm able to use the money that I have outside of my IRA to live life more now, to take more vacations, to buy more things, to make more of an impact, because I know that I have my IRA that's a safety net. So it's essentially like a hall pass to live life better. And that's what I do is I put these hall passes in as whole life insurance, as Roth IRA, as various investment vehicles that allow me to go on a month-long vacation around Central America and it not be a financially dumb decision, but rather it be a financially smart decision. This is how, if you really look at this stuff, you can use these kinds of things to create a life of abundance and freedom. And it does become sexy. So no, retirement accounts don't have to be boring. They can be awesome. You just got to know how to look at them. 529 and HSA, those are essentially vehicles that allow you to put money in and save on taxes. And as long as it's used for specific purposes, like the 529 is typically for college for your kids. So you can put money into it and you get tax breaks and all this stuff, it grows and everything. And then as long as it's used for college, you get tax breaks on the backside too. And HSA is a health savings account where you can put money into it, you get tax breaks on it, you can invest it in whatever you want. It grows and grows and grows. And as long as that money is used for health reasons to pay medical bills and things like that, then you get all the tax advantages. Real estate, baby, the greatest asset class, in my opinion, in the world is real estate, specifically rental real estate, specifically healthily leveraged rental real estate. And what I mean by that is you've got relatively low interest mortgage financing. And I like fixed debt. I'm not a variable debt kind of guy. I do have some that, but most of the time I would recommend fixed debt, meaning the interest rate doesn't change. So why is real estate so powerful? Well, First off, quick little stat for you. As of this recording, people who own real estate have a net worth that is 40 times on average what a renter's is. Just the people that writ large across all classes, across all everything in America, people who own real estate have an average net worth of 40 times the average renter. So there's a case for you right there. If you're like, oh, well, should I buy real estate? Well, do you want to have 40 times the net worth of what you do right now? Right? Buy and sell versus buy and hold. This is, everybody loves the show Flip or Flop and all these other flipping shows. But what they don't tell you is that flipping is an extremely active business, meaning it's taxed at the highest rate. It requires all of your time and attention. It has a higher risk profile, and most flippers don't make as much money as you think. And they also are not building assets. They're selling all those assets away versus somebody that buys and holds. When you buy and hold, you get the asset, you get the rental property, you get the rental income, and you get the power of time. And when you understand the 5 pillars of rental real estate, you will not be able to sleep at night for the excitement. The 5 pillars of rental real estate are cash flow, baby. Cash flow is the big one. Cash flow, appreciation, tax benefits, let's call it amortization or principal pay down, right? Paying down the loan, and in the power of time. Let me go through them one by one really quickly. When you buy a rental property, a tenant moves in, they pay the rent. Your property manager or you collect that rent, you take out the expenses, and you keep the rest. After all of your expenses, whatever is left over is your cash flow. You didn't do anything. That property and that renter just paid you money every single month. You get cash flow. You get enough cash flow coming into your life to cover all of your monthly expenses. You're financially free. When you have enough cash flow to cover all of the expenses of your lifestyle, you do not need a job. And so you can travel around if you want to. You can do whatever you want to. Literally, you can do whatever you want to without a job and without a boss once your cash flow reaches the amount of all of your monthly expenses. That's it. That's how you achieve financial freedom. So cash flow is huge. Then you have appreciation. As you guys are probably aware, houses appreciate over time because of inflation, because of population expansion, because of wage increases, and so on and so on. So just in general, real estate, even if you don't do anything to it, over time will go up in value. And every time it goes up in value, your net worth goes up. So appreciation. And by the way, appreciation takes advantage of compound interest, because if your house appreciates 10% one year and then 10% the next year, it's 10% on top of that 10%. That's compounding. So when we said take advantage of the compounding interest, buying a piece of rental real estate does that. The third part is tax benefits. You get a slew of tax benefits from owning rental real estate. I'm not going to get into it in detail. The supplemental materials and the support team can give you all of that information. But you get a huge tax haven from owning rental real estate. Okay? Then the other part is the principal pay down. So when the tenant pays you rent, if you have a mortgage with a decent interest rate, part of your expenses is your mortgage payment. Well, a mortgage payment is typically broken down into 4 segments: principal payment, interest payment, tax, and insurance. So part of that, right, the taxes, insurance, all that stuff, they're all expenses. The interest, that's all expenses that goes away. But the principal payment pays down your loan. So if you have a $100,000 loan and I make a principal payment of $500, you don't owe $100,000 anymore. You owe $99,500 because the principal goes toward paying off your loan. Well, what does that do? If I have a $100,000 house and I have a $100,000 loan on it, then there's no equity in that house. I don't own any equity. But if my renter pays off the mortgage that month and it takes off $500 off of the payment, off of the loan amount, well, now I have $500 of equity in that house. And every single month, my equity builds and builds and builds and builds because the renter is paying the mortgage for me. It's almost like having a checking account and having somebody else putting money into that checking account every single month for as long as they're there. So when you have those two things combined, the house appreciating, creating equity based off of just the power of time, and then the principal being paid down through what's called amortization, the renter paying your mortgage, All that stuff in the middle, that is your equity. So when your equity builds and builds and builds and builds, so does your net worth. So when you sell that house down the road or refinance it or do whatever, you've got all of this money that's built up over time. And the fifth and final one is time, the power of time. When you buy a house in year one, it'll make a certain amount of cash flow. It'll be worth a certain amount. The next year, all else considered, it will likely be worth more. You'll likely owe less on it because your tenant's been paying down your mortgage, and your rent will likely have gone up as well because rent goes up over time and so does housing prices. So 5 years from now, your house is worth way more than it was. You're renting it for way more than it was. You're still making the same mortgage payments because it's a fixed payment, but it's paying down faster and faster principal every time. And so your equity is building at lightning speed. You're getting huge tax write-offs, and you're not doing anything. It's just letting time do its thing. The power of time, these 5 pillars of rental real estate are what have allowed me and hundreds of other people within Whitefeather create true financial freedom and live the lives that we dream of. The power of time in rental real estate. So I know I went off really long on that, but that's hugely important. And as we move into the next videos, we're going to talk about how to create a blueprint to stack your portfolio with these rental properties so that you can use the power of time to build financial freedom. Okay, let's go into use your liabilities really quickly. I'm gonna hit these fast because I don't want this video to be too long. I just get super pumped and excited about like the power of these assets and how they're going to change your life that I tend to go on and on. Okay, what the heck are liabilities? Are they bad or not? Well, in general, a liability is something that takes money out of your life, out of your account. So that's bad. That's not good. But are these things really bad? And how can I make them work for me? Credit cards, are they good or bad? Ask yourself that. Are credit cards good or bad? What you probably said at this point is neither. They're neither good or bad. Or you probably said it depends. And you're right on both counts. They're neither good nor bad. It's what you decide to do with them. If you use them to buy frivolous things, if you use them to just pay for things that you don't need, or even pay for things that you do need and you don't pay them off at the end of the month, then that compounding interest is working against you because it's building and building. The amount of credit card debt goes up and up and up and up and up, and you're facing these huge interest rates. So in that case, when you use them like that, they are bad. But what if you use them to buy things, to build your credit, to borrow 0% financing, and all of that, and then don't ever make any interest payments because you're paying off the principal every month? What if you use them? And I do. I every year I put hundreds of thousands of dollars on my credit cards every year, but I will never pay any interest because I always make sure they're paid off. In that case, credit cards are vital for me. I love getting the points. I love getting the fraud protection. I love all of the things. I have dozens of credit cards and can I can borrow or I can use hundreds of thousands of dollars from those credit cards, but I never pay any interest. In that case, they are very good and a vital part of building my business. Understand that personal debt is not personal. It is something that you use. A lot of people, the reason I say it's not personal is because a lot of people are averse to borrowing lots of money because they think that debt inherently is bad. Oh my God, you've got millions of dollars of debt. That must be terrible. You should pay all that down. Really? Well, what if I borrowed those millions of dollars of debt or tens of thousands or 5,000 or whatever? What if I borrowed all that debt at 5% interest and I've got it invested in a rental property that's giving me a net 15% interest and it's growing over time? Is that good debt or bad debt? Well, that's great debt. So I personally have millions and millions of dollars of debt, and that's not a bad thing because I've got it at lower interest rates than what I've got it invested in. And so that debt, that other people's money, is growing my net worth and contributing to my financial freedom. So it's not personal. You shouldn't look at yourself as good or bad based off of debt. Debt is just a tool. It's just a tool. And if you remember the principle of arbitrage, the wealthy code, you borrow that debt at a lower interest rate than what you're getting on your investment. And that's it. That's the wealthy code. And it's so simple that most people don't believe that it could be that simple, but it really is. borrow low, invest high. Car loans. How do car loans work? Normally, if you're buying a car, you're going to get financing through that auto shop. And it's hit or miss as to whether or not they'll give you a good deal. It does depend entirely upon your credit reports and your cash reserves and your credit history and so on. If you have a really stellar credit report, then you're probably going to get decent terms even at the dealership. If you have a terrible credit report, forget about it. You're going to get fleeced. My first car payment, my first purchase of a car, I got a 16.9% interest rate on my car. And I had no idea if that was good or bad. It's horrific. Just newsflash for you. That's a terrible, terrible car interest rate. But I didn't know that. And so I got it and I paid on it, paid a ton of interest, and then got it repossessed. But that's another story. So car loans, you can get them. You can get a car loan basically from the dealership, or you could get it from Navy Fed or USAA or any bank that you choose. But the big thing to remember about car loans is that you don't want the interest rate to be too high. And you want to make sure that your credit is good before you go to get a car loan if possible, because they're very, very sensitive to your credit score. They will literally put you in tiers. And if you have a credit score that's lower than a certain amount, boom, you immediately get hit with price increases. So I'm a fan of car loans, meaning you could have your car paid off if you want, but let's just say you go buy a $30,000 car and you have $30,000 and you use that money to pay off your car. And now you're driving a free and clear car and you're happy with yourself because you're driving around a car that you own free and clear. Okay, that's fine. That's not a bad place to be. But what if instead you took that 30,000, you got a car, you put zero down on it, and got a 5.5% interest financing on it. So let's say a 7% interest financing. Who cares? 7% interest financing. So zero down, you're driving the car, but you're paying 7% interest on the $30,000 you borrowed from the dealership to buy that car. Then you take this 30 grand you've got in the bank and you invest it in a rental property that gives you 15% return. You're now driving a car that's charging you 7%, and you've got a rental property that's giving you 15%. Well, you take the 7% from that 15, pick the car payment, and then you keep the extra 8% for free. Does that make sense? You're literally creating arbitrage in all these areas of your life. So pay off your car if you want to, sure. But what I would say is take a look at the underlying interest rate first. And if you can put that money to work getting a higher interest rate than what you're paying to own the car, well, then it's an obvious decision. How does the mortgage work? Okay, we talked about this before a little bit when we discussed amortization. I'm going to try to keep this simple because a lot of people can get confused by this because they don't understand why. And what I would say is don't worry about why. Just worry about how it works. When you get a mortgage, and let's just say it's a mortgage for a home, 30-year fixed interest rate. Follow me here. 30-year fixed interest rate. And that means that over 30 years, each month you're going to make a mortgage payment that's going to include the principal and interest at a minimum. Normally they impound taxes and insurance as well, but at a minimum it's going to be principal and interest. And that payment is going to be the exact same payment in month 1 as it is month 360. So what happens is at the very beginning, and you can look at this chart down here, at the very beginning, you pay a lot of that mortgage payment toward interest. So let's just say it's a $500 a month mortgage payment. Probably more than 3/4 of that mortgage payment is going to be interest. It's going to apply to the interest. The mortgage companies charge most of their interest up front. And the main reason they do that is because they know that you're probably not going to carry this loan all the way to 30 years. You're probably going to refinance it. You're going to sell the house. You're going to do whatever. And all the mortgage payments that they got were primarily interest. And so they make more money that way. That way they're able to allow you to have these relatively low mortgage rates and relatively low payments, but they like it because they're getting mostly interest. And when they get the entire loan paid off, they get all that principal back, plus they get to keep all the interest. It means that they made a lot more money. That's why they're willing to do it. What does this mean to you, though? It means that the longer you hold a loan, the better it is. Because every single month, the amount of that mortgage payment that goes toward principal goes up and up and up, and there will be a breakover point at some time in the future where a mortgage payment of $500 is made and 50% of that goes toward principal. Why is this important? Because every time a mortgage payment is made, a little chunk of that pays down your principal, meaning you owe less, meaning you have more money. Your net worth has increased because your liability, your loan is smaller, but the asset is still the same value or higher. Okay? Stick with me here. Watch this video multiple times if that's throwing you for a loop. This is an incredibly important principle to understand. The amortization schedule, the loan paydown schedule. It's important to understand what that means. And it's important to understand that the longer you hold a particular mortgage, the faster it pays itself down. And that has all kinds of implications in the future. Taking property subject to and assigned, all this other stuff. Don't worry about that right now. Just understand how a mortgage works. The lower your interest rate, the faster it pays itself down. Because the lower your interest rate, the less overall interest you're paying. So obviously you want to try to get the lowest interest rate possible. And just bear in mind that every time you refinance a property, the loan resets. The amortization schedule starts back at the beginning where you're paying mostly interest. That's how a mortgage works. And when you can get your head wrapped around that, you can start to understand how you can use mortgages to your advantage and get somebody else to pay them down and pay them down really fast so that your net worth grows and so your financial freedom grows. Understand, this is the last point, and then we'll be done with this video. Okay. I know some of this stuff seems a little bit academic and confusing, but this is the blocking and tackling stuff that you're going to need to internalize so that you can start taking actions like a wealthy person would. Because once you add up enough of those actions, you become financially free. It's just the way it works. There's nothing stopping you from becoming financially free except learning all of these secrets of the rich and then putting them into place. Liabilities, in my opinion, are the most powerful thing that can set you free. The reason I say that is because right now, if you're anything like most people, you have a certain amount of money. You probably don't have a ton of it. If you had a ton of money, you would not be going through this course. You're going through this course to learn how to make more money and learn how to become financially free. So if you're not sitting on a boatload of cash, then how in the world can you invest your way to financial freedom? You don't have the money. And that's what stops most people dead in their tracks. I don't have the money, so how am I supposed to invest my way to financial freedom? This isn't for me. I might as well go get a job, work hard, all that stuff. That's fine. But if you want to know how you can get to financial freedom while you're still young, it's by using other people's money. It's by leveraging your way. When I say leverage, I mean using other people's money, private money, card money, whatever. In this instance, it's going to be mortgages, using the banks to loan 70, 75, 80% of the cost of a house or of an investment, giving you relatively low interest rates, and then getting somebody else to pay that loan off for you. That's the secret to becoming wealthy. Now, we're going to go on and we're going to give you an example, because I know a lot of this stuff is theoretical. A lot of it is, well, what if you had this problem, this stuff? We're going to go through a specific example, and I'm going to go through it slowly so that you can understand all the different pieces of it. And then I'm going to go through different permutations of it, because we're in the meat of it now. I'm going to show you on this next video a slideshow presentation of the spreadsheet that's used to run analysis on properties. And that's the meat of this module, is getting you to the point where you can understand how the numbers work, plug them into the spreadsheet, run different scenarios so you can go out and start analyzing properties and take away the mystical, magical, sort of nature of this. This is not mystical. This is not something that only super smart people can do. This is something that anybody can do. And the opportunities are everywhere around you. You just have to know how to use the right tools and how to use the right analysis techniques to find those good deals. And then you bring in, leverage other people's money, and you acquire these assets. And when you acquire enough of them, the cash flow alone will set you financially free. and you will build your net worth while you sleep. I'll see you in the next video.